welcome to each one of you. My name is Nikhil, Nanaiah, and the topic for today's presentation is Section 194IA of the Income Tax Act 1961, which deals with TDS on sale of immovable properties, the concepts and issues. My presentation will be divided into three parts. The first part I will deal with the current scenario with respect to immovable property and the reason why there was a need for TDS on sale of immovable property. In the second part, I will deal upon what exactly is Section 194IA and the practical procedure with respect to TDS and remittance to the government with respect to this section. And in the third and final part, I will deal upon the issues with respect to Section 194IA. So first, let us understand what the current scenario is in respect of immovable property. The Indian real estate sector is one of the fastest growing in the world. It has a market size worth $80 billion and this market size is expected to rise to $180 billion by the year 2020. India ranks 20th among the top real estate markets in the entire world. Its investment volume of rupees 19,000 crores only in the financial year 2012-13. The real estate sector contributes close to 5 to 6% to the gross domestic product of India, which is commonly called as the GDP. Also, real estate is considered as a very safe investment because most of them invest in real estate due to its steady appreciation in value, and therefore there is a constant demand for real estate in India. Now, why was there a need for TDS on immovable property? The real estate sector largely runs on informal financing and was unregulated. Due to the rise in demand for real estate, the size of transactions and the number of transactions grew enormously. Due to this, transactions were heavily underreported and undervalued, because of which almost half of the transactions never carried the PAN of the parties concerned to the transaction. As a result, property transactions were used as a means to park and generate unaccounted money, which is also commonly called as black money. So in the year 2013, the then Finance Minister, Mr. P. Chidambaram, while presenting the budget for the year 2013 and 14, introduced TDS on sale of immovable property under the provisions of Section 194IA of the Income Tax Act 1961, with effect from 1st of June 2013. This was done with an intention to bring in transparency by improving the reporting mechanism and tightening screws on corruption. Also, this would result in widening the tax base through taxation of capital gains. Now, let us understand what is Section 194IA. Section 194IA is divided into three subsections. Subsection 1 states that any person being a transferee responsible for paying other than the person referred to in Section 194LA to a resident transferor any sum by way of consideration for a transfer of immovable property other than agricultural land shall at the time of credit of such sum to the account of the transferor or at the time of payment of such sum in cash or by issue of check or draft or by any other mode, whichever is earlier, deduct an amount equal to 1% on such sum as income tax thereon. To put it very simply, this simply means that on the sale of any immovable property, tax must be deducted at the rate of 1% on the sale consideration at the time of payment or credit to the account of the seller. Subsection 2 states that no deduction under subsection 1 shall be made where the consideration for transfer of immovable property is less than 50 lakh rupees. Now what does this simply mean? That there shall be no tax deducted at source in case there is a sale of immovable property other than agricultural land where the sale consideration is less than rupees 50 lakhs. Subsection 3 states that the provisions of section 203A shall not apply to a person required to deduct tax in accordance with the provisions of this section. Now, what does section 203A state? It states that to make tax deducted at source, one must have a TAN, that is a tax collection and deduction account number. But this section is exempt to the provisions of section 203A, which means that to make tax deduction at source under section 194IA, one does not require a TAN. Now let us understand the explanation to section 194IA. The explanation for the purpose of this section is agricultural land means agricultural land in India, not being a land situate in any area referred to in items A and B of clause 3 of subclause 3 of clause 14 of section 2. Now what does this section 2 subsection 14 clause 3 state? It states the meaning of agricultural land with respect to population in a municipal area. It gives you the boundary for demarcating what is agricultural land and what is non-agricultural land based on the population of that area. Second, immovable property means any land other than agricultural land or any building or part of a building. So basically it means that any non-agricultural land or any building or part of the building. Now let us understand how to deduct and remit TDS. Now, the purchaser must deduct tax at the rate of 1% on the sale consideration. Here, one must understand what sale consideration is. Sale consideration is the amount paid or credited to the account of the seller. And this sale consideration does not mean the deed value or the fair market value of the property. It means that it must be the amount that is paid or credited to the account of the seller. Also, TDS must be deducted at the rate of 1% on the entire amount, suppose it exceeds 50 lakhs. Therefore, let us take an example. For example, let us take that the transaction value for the sale of immovable property is rupees 90 lakhs. Under this case, TDS must be deducted at 1% on the entire rupees 90 lakhs and not on rupees 40 lakhs, that is 90 minus 50 lakhs. On the entire amount of 90 lakhs at the rate of 1%, which amounts to 90,000 rupees. The tax is to be deducted at the time of credit or payment to the seller, whichever is earlier. Here the date of transfer is immaterial, as TDS is not required to be made on the date of transfer but at the time when payment is being made or credited to the account of the seller. So, supposing there is an advance payment made towards a purchase of property, then TDS must be deducted on such advance payment. Also, if there is payment being made in installment basis, then TDS must be deducted at the rate of 1% on each installment whenever the payment is being made or credited to the account of the seller. Next, to reduce the burden on behalf of the purchaser of property, there is no requirement of TAN for the deduction of tax under section 194IA. The purchaser must collect the PAN of the seller and must verify the same with the original PAN of the seller and provide the same on the online form 26QB. Now let us understand what form 26QB is. Form 26QB is an online form cum statement challan, which means that this form 26QB can be used for disclosing of information regarding the sale of immovable property and also to make payment to the account of the credit of the government on the basis of TDS. Now, PAN of the seller as well as the purchaser must be disclosed in the form 26QB. One must make sure that no error must must be committed while filling the form 26QB, as this is an online form and there is no online mechanism for rectification of errors of this form once it has been submitted. In case of multiple buyer-seller combinations, form 26QB must be filled for every payment made to every seller. For example, if there is one purchaser and two sellers, then two form 26QBs must be filed for payment made to each seller. For example, if there are two buyers and two purchasers, then form 26QB must be filed 4 times for the appropriate proportion of property. The tax deducted has to be deposited with the government within 7 days from the end of the month in which tax has been deducted. Now let us take an example. I have purchased a property on 22nd of October 2014. Now I must deduct tax and remit it to the account of the government by filing form 26QB by 7th of November 2014. That is 7 days from the end of October 2014. Online filing of form 26QB is the must, which means that there is no paper form for filing of form 26QB. The online filing of form 26QB and the payment of tax can be made either through internet banking or through any other branch of a bank through which they will use their internet banking services and make the payment on your behalf. But online filing is mandatory. The online filing must be done on the website of the Tax Information Network, which is www.tin.nsdl.com. The purchaser must download TDS certificate in form 16B from the Traces website and furnish the same to the seller within 15 days from the due date of filing form 26QB. Now, for example, if we take the earlier example in which I have deducted the transaction has taken place on October 22nd, 2014, then I would have filed form 26QB by 7th of November 2014, and within 15 days, that is by 22nd of November 2014, I must submit form 16B to the seller saying that I have deducted tax at source on your behalf. In case of failure to comply with the provisions, interest and penalty would be imposed to the purchaser as per section 201 of the Income Tax Act 1961. Interest will be charged at 1% per month or part of the month for failure to deduct tax or short deduction of tax from the date the tax was deductible up to the date when tax has been deducted. Interest will be charged at the rate of 1.5% per month or part of the month thereof where tax has been deducted but has not been remitted to the account of the government from the date of deduction up to the date when actual payment to the account of the government has been made. So now let us understand how to practically file form 26QB online. First, one must go to the Tax Information Network website, that is www.tin.nsdl.com. On going there, you will find a box which says TDS on sale of property. Click on that box and then select online form for furnishing TDS on property form 26QB. On selecting that, you will be taken to the online Chalan page. There you will have to select the applicable Chalan, which is TDS on sale of property. On selecting that, it will direct you to the form 26QB page of the Income Tax Department. Now this is an online form where you will have to give details whether this is tax on companies or income tax other than companies. You will have to give details regarding the financial year and assessment year and select the type of payment, that is TDS on sale of immovable property. You will have to give the permanent account number of the seller and the permanent account number of the buyer. Also, you will have to give the complete address details of the seller as well as the buyer. Also, you have to give details whether there is one seller or multiple sellers, or whether there is one buyer or multiple buyers. Next, you will have to give details of the property that has been transacted. You will have to select the type of property, whether it is land or building. Next, you will have to give the complete address of the property that has been transferred. Also, you will have to give the date of agreement or booking, the total consideration, that is the property value that you have paid for acquiring the property, and the payment type, whether the payment has been made in lump sum or whether the payment has been made in installments. Next, you will have to give details regarding the amount paid or credited to the seller. So you'll have to give the complete details in crores, lakhs, thousands, hundreds, tens, ones. Also, you'll have to give details regarding the tax deposit details. Total amount of paid or credited to the seller. Next, you will have to enter the TDS rate, that is 1%. Also enter the TDS amount by calculating 1% on the total amount paid or credited to the account of the seller. Also make sure that you enter the TDS amount in the TDS amount to be paid field and not in the interest or fee field, as if you enter in these other fields it will not reflect in your Form 26AS statement. Also you will have to give the details of value in words. After that, now you will have to decide whether you will be making the payment through net banking where the transaction will happen immediately, or whether you want to make a payment on a future date by going to a branch and making the payment. Now by going to a branch and making a payment, it is easy for people who do not have an internet banking access. So for those who have internet banking access, they can immediately make the payment. So you can select e-tax payment, give the bank name, date of payment or credit to the seller, and the date of transaction. Next, you will get a captcha code which you have to fill in, and then you will have to click on proceed. On clicking proceed, you will come to the confirmation of data page. Here you will have to confirm the details that you have provided. In case all the details that you have provided is correct, then you will have to click on confirm. In case you want to make any changes, this is the final stage where you have to make any changes by clicking on edit, making the changes, then confirming. Once you have confirmed, no changes can be made. On confirming, you will get an e-tax acknowledgement number. This is a 9-digit acknowledgement number. Now supposing you are making payment by going to a branch of a bank, then you will have to take a printout of this form along with the acknowledgement number and submit it to the bank. The bank will type in this acknowledgement number and make the payment on your behalf. In case you want to submit it to the bank, as in you want to make the payment by internet banking, then you'll have to click on the submit to the bank button and it will redirect it to the internet banking page of your respective bank. So this is how practically Form 26QB has to be filed. Now coming to the final part of the presentation, which is the areas of concern. There are a lot of areas of concern based on section 194IA. The first area of concern is the date of transaction. This section is applicable to all transactions from 1st June 2013. However, there is no clarity regarding transactions where sale agreement is made after 1st June 2013, but consideration for the same has been made before 1st June 2013 or vice versa. The second point is unnecessary burden on non-taxpayers. Suppose the seller does not have any taxable income and as a result isn't filing any income tax returns, then the seller will have to bear the additional burden of filing income tax returns only for the reason of claiming complete refund of the tax that has been deducted at source on the sale of immovable property. Next is the concern of lower rate of return. Suppose the seller does not have any taxable income and is eligible to claim complete refund of the tax that has been deducted on sale of immovable property, then the refund will be given back to the person by adding an interest of 6% per annum. Supposing there was no TDS, then this person could have invested this amount on some other investment which would have given him a higher rate of return. Therefore, he would be losing a certain amount of return in the form of interest. Technical issues with respect to online form 26QB. In the online form 26QB, the field of PAN is made mandatory, which means that without filling in the PAN details, you cannot proceed with the transaction of filing form 26QB and remitting the amount to the government. Now supposing the seller refuses to give you the PAN details, then TDS has to be made at the rate of 20%. Now, suppose the seller doesn't give you the PAN details and you are required to make TDS at the rate of 20%, online form 26QB does not have an option where you cannot enter the PAN of the seller. Therefore, you cannot proceed with the transaction, and therefore the SSE will become an SSE in default. Next is the cancellation of sale agreement. Suppose I have made a sale agreement and after sale of the property, I have deducted tax at source on behalf of the seller, but on a future date, the sale of the property gets cancelled. Now, there is no online mechanism to claim refund of the tax that has been deducted. One has to go to the income tax department and write a letter or meet one of the officials to claim a refund of such amount. Next is the case of TDRs and DRCs, transfer of TDR or DRC. Now, one must understand what is a DRC. A DRC is a development rights certificates. Now, for example, the government acquires your property for the purpose of certain infrastructure project. Now, the government does not give you consideration by giving you land in a new place or by paying you in terms of cash. Instead, they will give you something called as a development rights certificate. The development rights certificate gives you the right to build more built up area in a particular property or any property of your choice. Basically, it gives you more amount of built up area compared to the existing rules. So basically, this relates to immovable property. Now, I can also sell this development rights. There can be a transfer of development rights for a cash consideration. Now, there is no clarity on whether TDS under section 194IA is applicable on sale of transfer of development rights. There is a recent judgment on 19th of November 2014 with respect to the Income Tax Appellate Tribunal Bangalore and the Brihat Bengaluru Mahanagara Palike. But this judgment relates to TDS under section 194LA, but there is still no clarity under section 194IA. The next area of concern is property received without consideration. Suppose there is a sale of property without consideration. I do not pay any money and I receive a certain property, say for example a gift, or I give you my property and in return you give me your property. There is an exchange of property. In such a situation, there is no clarity on whether section 194IA is applicable on the value of the property. Also, the most important and the last area of concern is loan from banks and financial institutions. In case a customer takes a loan from any bank or financial institution and the repayment of loan is through EMI, the payment by customer in form of EMI to the bank or financial institution is towards the consideration of purchase of property and the interest thereon. In such a circumstance, it is not clear whether the customer is supposed to deduct and pay TDS under section 194IA out of each and every installment paid to the bank or financial institutions. This leads to unnecessarily complying on 194IA. However, there is no clarity. Normally, banks and financial institutions are exempt from the purview of tax deduction under section 194A of the Income Tax Act. However, under section 194IA, there is no such provision. So these are the concerns with respect to section 194IA. Coming to the conclusion. With a detailed review of section 194IA, we understand that the provisions of this section has improved reporting and compliance with respect to sale of immovable property, and at the same time has widened the tax base of direct tax collections. There seems to have been a check on using real estate as a means of generating black money and parking black money by using real estate. However, bringing in clarity on the nuances of this section would save unnecessary confusion, non-compliance and litigation on part of the parties to the transaction. With this, I believe that I have brought in clarity towards section 194IA of the Income Tax Act. It was great giving you this presentation. I hope you all liked it. Thank you and have a nice day.